Look, I'm gonna say this straight because you need to hear it. If you think Bitcoin just crashed, you're already behind, man. That minus 35% wasn't panic. That was the first warning shot fired into global liquidity, and Wall Street's only now rubbing its eyes awake. And trust me, once you understand why Bitcoin moves before everything else, you'll never look at these markets the same again. Bitcoin always leads because it's the fastest asset to react when liquidity quietly drains from the system. It's like the canary in the coal mine, but wired with 24/7 price discovery and zero circuit breakers. When funding tightens, leverage unwinds, and risk appetite collapses, Bitcoin feels it first. Stocks, they're slower, heavier, and way more protected. That's why they lag. Liquidity pulses basically work like the heartbeat of global markets. When liquidity flows in, everything pumps, everything looks healthy, and people think they're geniuses. But when liquidity gets pulled, even a little, beta assets get slammed instantly. That's Bitcoin. It reacts within hours. Stocks, they only start shaking when that liquidity pulse stops showing up altogether. And that's why stocks are only reacting now, weeks after Bitcoin screamed its warning. Stocks move on narratives, analysts, institutions, and delayed positioning. Bitcoin moves on raw liquidity, nothing else. And that delay, that's exactly what makes this moment scarier. Because stocks falling now means the liquidity problem isn't temporary. It's spreading. You can literally see liquidity drying up across everything. Risk assets bleeding together. Correlations spiking. Volatility exploding in places it usually sleeps. Stablecoin supply shrinking. Credit conditions tightening. And outflows hitting ETFs non-stop. This isn't normal market chop. This is liquidity leaving the room quietly, while everyone pretends the music's still playing. And here's the part nobody wants to think about. What happens next if liquidity doesn't come back fast? Because when liquidity vanishes, markets don't just dip. They crack. Prices disconnect from fundamentals. Correlations go to one. Forced selling triggers forced selling, and fear spreads faster than news. If liquidity doesn't return soon, this isn't the bottom. It's the beginning of something bigger. But before we talk about that next phase, you need to understand something way more important. Bitcoin didn't crash ahead of stocks by accident. It wasn't random. It was the system's early warning indicator doing exactly what it's designed to do. Reacting to liquidity stress nobody was watching. And the real question now is what that stress is signaling beneath the surface. Because the deeper you look, the clearer it gets. Markets aren't falling because of news, or headlines, or some event. They're falling because liquidity is quietly being drained out of the system, like someone pulling the plug on a bathtub. And once that process starts, the first assets to drown are always the ones most sensitive to liquidity. Bitcoin. Stocks, on the other hand, look calm until suddenly they don't. Institutions hold positions longer. Retail stays in denial. And analysts keep repeating healthy correction until the selling becomes impossible to ignore. And that's exactly where we are now. The point where indexes start reacting to a liquidity shock that began weeks earlier. And if you're paying attention, you can see the signs screaming from every corner of the market. Credit spreads widening, funding stress rising, junk debt losing bids, emerging markets wobbling, and liquidity providers stepping back. This isn't just correlation. This is systemic tightening, and it always hits slow-moving assets last. The scary part: liquidity shocks don't move in straight lines. They cascade. A small unwind becomes a bigger unwind. Margin calls spread. Weak positions collapse first, pulling strong ones down with them. And in a system built on leverage, one liquidity drain can turn into a full-on liquidity event way faster than people expect. And all of this brings us to the question everyone should be asking right now. What happens next if liquidity continues tightening at this pace? Because if central banks don't step in, if funding doesn't ease, and if risk appetite doesn't return, the next phase isn't volatility, it's contagion. And contagion is when every market starts moving in one direction. And if you think that sounds bad, wait till you see what's hiding in the bond market. Because that's where liquidity stress becomes real. That's where cracks turn into breaks. And that's where the entire system shows what's coming next, long before anyone on TV even mentions it. Yo, listen up. This isn't just another market dip. Bitcoin dropping 35% didn't happen in a vacuum. And if you think stocks falling after it is coincidence, you're sleeping on the biggest liquidity domino ever. Once you see how this chain reaction works, you'll understand why the entire system is on edge. Liquidity is the lifeblood of markets. When it flows, Bitcoin spikes first, because it's the fastest asset to sniff trouble and ride the waves of extra cash. Stocks lag, indexes lag, the economy lags, everything else just follows its lead. And that's exactly what's happening right now. Think of Bitcoin as the first domino in a line nobody sees yet. When liquidity tightens, Bitcoin falls. That triggers margin calls, levered positions start liquidating, and suddenly the next domino, the stock market, starts tipping over. It's fast, mechanical, and relentless. Here's the kicker. When liquidity disappears, correlations skyrocket. Assets that normally zigzag independently suddenly move in lockstep. Crypto, stocks, bonds, even some commodities. They all start falling together because liquidity is the glue holding their prices up. The US investor cycle makes it worse. Retail keeps buying dips, institutions try to rebalance, and media keeps calling it a healthy pullback. But behind the scenes, margin calls, forced selling, and liquidity stress are quietly stacking, creating a perfect storm nobody is warning you about. This isn't theory. Look at 2020. Bitcoin fell first. Stocks followed days later. Then panic spread everywhere. 2022 played out the same way under rising rates. The same domino pattern repeats every time liquidity tightens. And this time, the warning signs are screaming again. And it's not just price moves. The underlying system stress is building. Reverse repos draining. Treasury yields spiking. Credit spreads widening. Each domino is falling in perfect sequence. And most investors don't even realize what's happening until it hits their portfolio. When Bitcoin drops first, it's a signal to the market that liquidity is vanishing. Institutions scramble, retail panics, and the market starts a chain reaction that spreads through equities, crypto, and beyond. That's why you're seeing everything move together. It's not random. Every time liquidity tightens, the domino effect accelerates. One forced sale triggers another. Correlations converge, and before anyone knows it, the system starts moving like a single organism reacting to stress. And now the big question: where does the next domino fall? Historically, tech and beta assets get hit hardest first, followed by broad indexes, then riskier credit markets. That's the pattern, and the signs are pointing there again. You might think this is just about crypto or short-term trading. Wrong. This is systemic. The liquidity pulse is warning you that what's coming hits all corners of the market, from your favorite tech stocks to institutional funds leveraging positions. And the emotional trap. Everyone wants to buy the dip. Retail thinks they're getting a bargain. Institutions scramble to rebalance. But when the dominoes start falling, bargain quickly turns into panic. Timing matters more than ever, and ignoring this sequence can cost big. But the real danger isn't price. It's what's happening behind the scenes. The dominoes you can't see, the leverage piling up, and liquidity quietly evaporating are about to dictate the next moves. And if you blink, you'll miss the signs that could save or destroy your portfolio. Yo, wake up. If you think this Bitcoin drop was random, you're tripping. Weeks before that -35% hit, a hidden liquidity drain was already eating the system alive, and most investors didn't even notice. This isn't hype, it's the truth, and it's about to get ugly. The first clue: ETF outflows and stablecoin shrinkage. Money that was supposed to be in the system quietly disappeared. Nobody on CNBC mentioned it. Nobody tweeting about market trends saw it. Yet this tiny bleed was flashing warning signals loud and clear. And here's why this matters more than rate hikes or CPI numbers. Those are just headlines. Liquidity is the oxygen for risk assets. When it disappears, nothing else matters. Not earnings, not sentiment, not even the Fed's words. Markets breathe liquidity, and this oxygen leak was massive. Institutional players were pulling cash silently. Hedge funds, whales, and big banks quietly exited positions without creating a panic. They didn't sell to retail. They redistributed quietly while keeping prices artificially stable. That's why it looked normal on the surface. Meanwhile, retail investors, completely oblivious, everyone was still buying the dip, thinking it's safe. The warning signs were there, but nobody was connecting the dots. Bitcoin was flashing the early alarm, but casual investors just saw numbers drop. The timing of this drain is insane. It didn't start with the crash. It started weeks earlier. Reverse repo balances were shrinking. Treasury yields were creeping up. The liquidity pipe was narrowing quietly, and the market's high beta assets were sitting ducks. And when the pressure built, Bitcoin finally dropped first, hard. That wasn't the start. That was the first domino falling after weeks of stealth stress. and the ripple through stocks and indexes, just the system catching up to what Bitcoin already knew. Nobody wants to talk about it, but this is exactly how modern liquidity stress works. The market reacts late, headlines freak out late, retail panics late. Only insiders knew, quietly moving while the world stayed blind. The numbers don't lie. ETF outflows were staggering. Stablecoin supply was contracting. Funding rates were tightening. It was a stealth liquidity exit on a scale that usually triggers panic, but the public didn't see it yet. And the implications? Brutal. When liquidity leaves quietly like this, assets that seem unrelated start falling together. Bitcoin, tech stocks, leveraged ETFs, everything suddenly correlates because cash just isn't there anymore to support risk-taking. The scariest part, this isn't a one-off. It's a repeating pattern. 2020, 2022, same story. Hidden liquidity leak. Bitcoin reacts first, then stocks follow, then chaos spreads. If you miss it, you get hit with losses while everyone else is still clueless. So when you see the market wobble, don't blame sentiment. Don't blame headlines. It's the invisible drain that already started weeks ago. And Bitcoin was just the canary, letting you know exactly what's coming. And here's where it gets crazy. The data shows this wasn't random at all. Every major asset is connected. Every forced sale is predictable. And the market moves like clockwork once liquidity starts disappearing. Blink now, and you'll miss the next wave. Yo, listen up. If you think stocks and Bitcoin move randomly, you're tripping. Bitcoin always leads the SPX by 10 to 45 days whenever liquidity tightens, and ignoring that pattern is like walking blind off a cliff. The market whispers first, then screams, and Bitcoin is the whisper. Backtesting previous liquidity squeezes shows the same story every single time. March 2020. Bitcoin fell hard first. November 2021 through 2022. Bitcoin peaked and started sliding before tech stocks even blinked. The pattern is crystal clear if you actually look at the data. Stocks catch up late because they're slower, heavier, and full of institutional buffers. By the time equities react, forced selling kicks in, margin calls spread, and the fall ends up bigger than anyone expected. Bitcoin already did the heavy lifting while everyone else slept. And guess what? That same pattern is happening right now. Bitcoin led with a 35% drop, sending early warning signals. Stocks are just beginning to react, and if history repeats, what we're seeing now is only the start of the replay. Mainstream media will always be late. CNBC, Bloomberg, Twitter experts, they comment after the dominoes start falling, not when the first one tips. By the time the headlines scream market crash, Bitcoin has already signaled the entire trajectory. This pattern is like a secret code. Once you know it, you can read the market differently. Bitcoin moves first, liquidity drains, stocks lag, forced selling spreads, retail panics, and indexes correct sharply. Miss the code, and you're buying right into the chaos. And the next 30 days, Historical patterns suggest more downside for equities if liquidity doesn't return. Bitcoin already burned the trail, and the lagging SPX is following in lockstep. The math is uncomfortable but clear. History doesn't lie. Retail investors still holding long. They're walking into a late phase of the same pattern. This isn't hype. This is repeatable behavior observed across multiple liquidity crises. Timing and understanding the sequence matters more than ever. If you blink, you'll miss the full story. This isn't just about market drops. It's about mechanics, liquidity, and timing. The system moves predictably once stress starts. Bitcoin shows the start. Stocks catch up later. That's the secret nobody teaches you. But here's the real kicker. This time, the liquidity problem is global, not just US-centric. Every major market is connected, and the next 30 days could reveal just how synchronized these dominoes are about to fall. Yo, check this. If you think this mess is just crypto acting up, you're tripping hard. This liquidity collapse isn't isolated. It's system-wide, hitting everything from Bitcoin to tech stocks, and it's only getting started. Dollar funding stress is climbing fast. Banks, institutions, and hedge funds are struggling to source cash at reasonable rates. When the world's reserve currency starts feeling tight, every market feels the pinch. Emerging markets are showing early cracks. Currencies wobbling, capital fleeing, yields spiking. These are warning signs that liquidity problems aren't confined to Wall Street. Global risk is real, and it's spreading. Commodities aren't hiding it either. Oil volatility is surging. Gold is spiking. These moves confirm that liquidity is being drained across all corners, not just the speculative digital assets. Cash is king, and it's evaporating. The tech sector is particularly vulnerable. Better stocks, leveraged positions, and stretched valuations mean a liquidity drought hits harder here first. When funding dries up, tech gets crushed while everyone else is playing catch-up. Global money flow is slowing at a dangerous pace. Cross-border investments are retracting. Capital rotation is stalling. And liquidity injections are not keeping up. When global cash stops circulating, risk assets move in unison downward. Retail investors are still buying dips like it's a normal correction. Meanwhile, smart money is exiting quietly, preparing for the next wave of stress. This isn't a drill. It's a system-wide warning that liquidity is the real driver. If you ignore this, you'll get hit by the domino effect. From crypto to stocks, tech to emerging markets, the liquidity squeeze spreads faster than headlines can report. Timing is everything, and the early warning came weeks ago. And if global liquidity keeps tightening, here's the exact scenario we enter next. Margins unwind, forced selling cascades, correlations spike, and the system moves as one. And by the time most people realize it, it's too late. Yo, don't blink. If you think the Bitcoin drop was the full story, you're dead wrong. That minus 35% was just the opening act. What comes next is where the real shock hits, and it's about to affect every corner of your portfolio. Short term. Expect crazy volatility. Bitcoin stocks, and tech are all moving together like never before. Correlations spike, margin calls hit, and even blue-chip names aren't safe. This is liquidity stress in full swing, and it's messy. Medium-term, weaker earnings start showing cracks. Companies that seemed solid will reveal funding stress, debt servicing issues, and shrinking margins. Credit markets feel the pinch, and defaults creep higher. This isn't hype, it's the system under pressure. Key asset classes likely to get hit first: SPX, QQQ, and small caps. Tech-heavy indexes are sensitive to liquidity, leverage, and funding rates. When forced selling spreads, these get crushed faster than retail expects. Crypto bifurcation is happening too. Strong projects with real use cases will survive, but weaker tokens without liquidity support will vanish. This is Darwinian finance in action, and the market doesn't wait for sentiment to catch up. The Fed may be forced to act eventually. Either massive liquidity injections, emergency lending, or policy pivots to prevent cascading failures. But right now, they're still letting liquidity tighten, and the pain hasn't peaked yet. For investors, this means strategy matters more than ever. Hedges, cash, reserves, short-term bonds, and selective commodity exposure are your friends. Risky assets are traps right now, and patience will pay more than panic buying. And this is why Bitcoin's minus 35% wasn't a crash. It was the first warning. The real story is what comes next. Every domino has been tipped, and the sequence is unfolding. And if you're paying attention, you can survive, even profit, while others panic.